Hi, I'm Kevin Nunez, investor, entrepreneur, and professor. I grew up in a part of New York City where nobody was talking about saving or investing. We were in survival mode. I earned my bachelor's degree from Fordham University and an MBA from Cornell University. I worked my way up Wall Street firms like Morgan Stanley and Merrill Lynch. I did everything you're supposed to do. And I could have kept climbing that ladder, but I chose something different. I chose to build. I chose to teach. I chose to invest in our communities because too many families are often fed bad information about money and it costs them generations. So this is Invested in Us, where we break down money, markets, and ownership so our communities can build real wealth and real legacy. Hey everybody, my name is Kevin Nunez, founder of NJK Partners, and welcome back to another episode of Invested in Us, where we explain money how it should have been explained to us. All right, everybody, so before we dive into today's topic, I just want to highlight a huge milestone for us. Last week, NJK got recognized as a registered investment advisory firm. This means that we can now finally partner with everyday people. You know, historically, we've only been private equity investors, and legally, only millionaires or high income earners could invest into private equity deals. But now that we are registered investment advisors, we can now work with anyone. So at NJK Partners, we will have no account minimums, we'll have no commissions, and obviously no judgment. We are professionals. I've been on Wall Street well over a decade. I take what I do very, very serious. And you know, we're in it to help. And that's all we want to do is combat a lot of the bad information. You know, I'm not a fan of day trading. I'm not a fan of, Forex or options or this or that for the everyday person. I truly believe the everyday person needs to focus on what I like to call goals-based investing. And, when you focus on your goals, you don't take unnecessary risk. And I truly feel that, studies have shown that most active fund managers who are professionals in the industries that have all the resources in the world and teams of really, really educated people that have all these resources still underperform the markets, that they themselves set out to be about 80% of the time. We've spoken about it ad nauseum in the past, few episodes that we had with Vince Childers from Cohen and Steers. The reality is most professionals underperform their indexes. Why do people think that the everyday person, can outperform the markets? Like, no one's smarter than the markets. So it's important to just focus on your goals and important to focus on achieving what you need to achieve and not take any unnecessary risk. So, we founded NJK because we wanted to deliver high quality information to just everybody, not just an exclusive, group of people with resources. So, please, we invite you to join us across this journey. Feel free to reach out. We're always happy to talk about these things. We're happy to dive into a consultation. And, sometimes I truly believe that, getting advice that can help you avoid a landmine is equally as important. So, I'm here to help folks. Please take me up on that offer. And with that, let's dive into the state of capital. And wow, what a difference a week makes. As of last Friday, March 6, 2026, the S&P 500 was down about 1.5%. Now, most people would say that the markets have been pretty rich. The S&P 500 has had consecutive back-to-back double-digit years. So, at some point, something had to give. Recently investors are pointing to this war in Iran as the reason for volatility. And frankly, markets do not like unpredictability. Markets do not like, geopolitical tensions. Markets like political, gridlock in Washington, D.C. Markets don't like, extreme policies. And it's because of that you saw, the S&P 500 go negative on the year. I've been speaking year to date, how the S&P 500 was up, how the Russell 2000, again, 2000 of America's smaller publicly traded companies, was up, 7% at its peak or so. And now it was down 5% just last week. And, it's markets don't like smaller companies, right, that don't have the stability that more mature companies have during times of unpredictability, during times of political chaos, frankly, and wars breaking out in the Middle East and all sorts of shit. So the message here is that the world has changed drastically. Energy, S&P 500 as of last Friday was up almost 30%. That's insane numbers considering it's only, March 8th or 9th or whatever it is. So, we're seeing massive outperformance in energy markets. Just last night, crude oil surpassed $100. It reached almost up to 110. So it's basically doubled on the year. And obviously that could be inflationary because everything that, all the products and services people use come in on planes, trains, and boats and, trucks. So, diesel oil has gone up through the roof. So, people are going to see these costs show up not only at the gas pumps, but in everyday products and services. So, economists across the board are keeping out for inflation. What's the only tool that central banks have to combat inflation? It's to rise interest rates and purposely throw the economy a wrench and purposely slow it down to hopefully curb some of that demand and lower prices across the board. So, investors are frankly nervous right now about what's going on, and obviously there's a human aspect to it as well. But, as investors, we as capitalists, we have to deploy dollars for our clients. And, right now, investors are turning to quality, which is why you're seeing, investors move out of the Russell 2000 and you're seeing them move into value stocks. We spoke in a couple episodes how value stocks have outperformed growth stocks, and historically growth stocks have done better because those companies are reinvesting into their business and growing at a faster clip, where mature companies, value companies are paying out their earnings, they're paying out their distributions to the shareholders and whatnot. All right, so as we continue the conversation about the state of the economy, the data is pointing to a slowdown in the economy. Last week, we got a U.S. labor jobs report that showed about almost 100,000 jobs were lost in the month of February. Now, you could talk about the extreme cold or the snow or the strikes that were happening, throughout the West Coast or whatever. But the reality is economists were expecting 60,000 jobs to have been created, not 100,000 jobs to have been lost in the month of February. So we're seeing we're seeing job growth slow down pretty significantly because frankly, a couple years ago, we were growing at 200,000 jobs per month, creating 2 to 3 million jobs per year. We'd be lucky if in 2026 we break 1 million jobs created because, we're not exactly tracking that right this moment. So, that slowdown in job growth has central bank, the policymakers worried because, they have two mandates, and it's to one, manage inflation, which we know inflation is a fear right now given the, rising costs of energy. But their second mandate is to make sure Americans are fully employed, to make sure unemployment doesn't spiral out of control. So what tools do they have at their tool belt to combat these problems? Basically two. They can either raise rates or lower rates. And if we're in a inflationary environment, they're going to raise rates. And, the only other tool at their tool belt that they can use to combat these problems is monetary policy. Put more money into the system, aka print more money, or take money out of the system. Those are the only two levers that central banks can pull to, combat inflation or, bring down high unemployment. All right, friends, and continue the conversation about the state of capital. The VIX, the VIX, which is Wall Street's fear index, was up 26% just last week alone. It's basically doubled year to date. It's no secret that Wall Street investors do not like, unpredictability. They do not like the geopolitical tensions, and certainly they do not like war. So it's because of that we're watching the 10-year treasury spike up. Just in last week's episode, I was saying how it closed under 4% for the first time in a while. Well, guess what? That's no longer the case. It spiked up about 19 basis points just in a week. So the message here is that there's an underlying problem happening, and investors are, pricing this in and moving away from speculative, risky stuff into, hey, if shit hits the fan, this is where we want to be. Yeah, that's where they're going now. So it's important so that you, the everyday person, and friends and family and everyone watching, make sure that they plan accordingly. And this is why we always talk about goals-based investing. Because when I think about, if you want to make a particular investment in any particular, asset class, you got to think about the risk-return ratio. And if it's not aligned with your goals, there's a misalignment here. So, it's important that you plan accordingly. All right, friends. So let's talk about the breakdown. Honestly, I want to talk about target date funds. In finance, they honestly get a bad reputation, and that's because most financial professionals swear they know everything and they're way smarter than the markets. But I'm humble enough to know that I like simplicity. And I think the target date funds is honestly a great investment for the everyday person. I mean, you've probably looked at them in your 401ks and not known exactly what you're looking at. You probably see, something that has like 2050, the year 2050 or year 2055 or 2075 or 2030 or 2040 or whatever. A target date fund is basically a cookie cutter portfolio. And usually these are funds that are professionally managed. They're usually pretty cost efficient. If it's in your 401k, they're typically really tax efficient. And, they basically manage the buying and selling of your portfolio for you. And this is why I think it's a great, product for the everyday person, because it simplifies it. It's efficient, it's professionally managed, so it's diversified. It updates and rebalances periodically. Again, it's usually done off of your age based on when you're going to retire. So those years that you see when you're looking at your 401k plan, if it says 2050, the assumption is you're going to retire. You'll be somewhere around like 59 and a half or maybe 60, 65. In that year. And that's basically telling you that they're going to manage that portfolio with that risk tolerance in mind, assuming that you're going to cash out on that 401k plan, when you're over 59 and a half. So they buy and sell bonds, stocks, or everything in between, alternative investment, real estate, sprinkling some hedge funds and private equity, and they'll manage that for you for a pretty efficient fee, and remain diversified. It's a great tax strategy and retirement account. So for the everyday person, I like simplicity. I'm humble enough to know you don't have to make this any more complicated. And no, this is no offense to my day trading friends or my option traders or blah, blah, blah. But building wealth does not have to be that complicated, friends. And when I look at the holistic picture and I think about the fees that you're paying across each account, and I think about the taxes, the tax implications that you might be triggering when you buy and sell actively and you day trade and you do all of this, and then you factor in the fact that most of these people are losing money on their trades, it's a losing strategy. So I like simplicity. The way I live my life is real simple. I have checking and savings. I have a brokerage account where I do my trades and stuff. You got your retirement accounts. But for the most part, my life is largely consolidated. And I don't like to make things any more complicated than they have to be. So the message here is that if you have target date funds in your retirement plan or something, that's honestly, for the everyday person, that's probably a better option than doing it yourself. Doing it yourself is probably a losing strategy, frankly. So, and I think most industry professionals will agree with that. Honestly, I know hedge fund managers that use financial advisors, and I know other industry professionals that still use financial advisors, because when it comes to talking about, estate planning and getting it to the next generation efficiently without Uncle Sam taking a huge portion of it, or planning for your child's education, saving for your first home, or just getting out of debt and saving up some money and creating that wealth, that's very, very different than asset allocation, or what's the trading multiple on this particular stock, or blah blah blah, or whatever the technical term is. So the message here is, going back to goals-based investing, you always want to plan accordingly. All right, friends, so let's talk about the Property Playbook, a new segment on Invested in Us, in which every week we're going to talk about, a particular topic in real estate and deliver, again, high-quality financial education here. And as a real estate investor and as a real estate professor, it's only right that I deliver real estate content. So the most important, and we spoke about this a few weeks ago and a few episodes ago of Invested in Us. I described asset allocation, right? There are different asset classes. You have stocks, which are essentially equity investments into a company. You basically own a portion of that company. Then you have a bond, which is an IOU, whether you're doing a bond for the U.S. government, you're at Treasury, or state or local municipality or somewhere in between. Those are all bonds. And then you also have alternative investments. Think hedge fund strategies, private equity strategies, etc., etc. Then real estate would fall under alternative investments. But even when you double click on real estate, there are various asset classes. So I like to think of, there's honestly more than a dozen when you think about, real estate. So the first subsector within the real estate asset class would be residential. Everybody knows residential because we all need a place to live. So residential could be single family home, it could be multi-family homes, or it can be manufactured homes and things like that. So, that's just like the first food group of real estate. Then you have office space. Everybody knows office space because, you could think of like the Empire State Building, the Freedom Tower. Those are just some landmark, office spaces in New York City. But everybody knows office space. Then you have industrials, which could be warehouses. That's a real effect given the Amazon effect. Everybody, I know myself, I'm ducking and dodging boxes on the daily basis in my house because of all the shit that comes on in. And then you have retail, which, retail could be malls, both indoor and outdoor. You have hospitality, that could be malls. You have hospitality, that could be hotels. So these are just some of the food groups within real estate. And of course, any investor should always remain diversified. So, when it comes to real estate investing, it's a little harder to be diversified if you're in the private markets because these are hard assets that, typically are very, very hard to liquidate. But if you're, trading real estate securities or you're buying REITs or something like that, that's a different way to enter the real estate play without, those high barriers to entry. If you buy a REIT, a real estate investment trust, which is basically, a pooled investment, which is investing into cash flowing assets, which will be real estate in this example. Typically, you can play certain spaces without 20%, 30% down payments, without having to finance the whole asset, and those strategies are professionally managed. So anyways, the message here is that within real estate, you do have various subsectors. And the main food groups are the ones that everybody knows and loves for the most part. You have residential, you have office, which commercial. You have malls, you have, and now you have data centers, self-storage, you have, dorms. This goes senior citizen care. This goes way beyond, buying a 2 or 3 family house. And on this platform, we will discuss them all. All right, friends. So let's talk about policy and economics because we are officially at the start of the election season. So this is important because this is the midterm election for Trump 2.0. And in the last election, the Republicans won all 3 chambers of government. They won the presidency, they won the Senate, and they also won the House of Representatives. So right now, the way things stand, the Republicans control all 3 chambers. Wall Street has always been a fan of gridlock. And, Wall Street is always in the camp of slowing things down because having a predictable environment to do business in makes it easier to make investment-related decisions, makes it easier to deploy millions and billions of dollars when there's, some sort of predictability in the regulatory landscape or in, the political landscape. So we are in a midterm year. And right now, most of the reports that I'm seeing show that the Democrats have a slight advantage on possibly winning back the House of Representatives. Now, I'm reading all sorts of stuff that show that they might also take back the Senate. That's, unlikely. Possible, but unlikely. It's more possible that they're going to win back the House of Representatives. So if the Democrats were to take back the House, that would mean that the government is divided, and that is exactly what Wall Street wants. They like that gridlock because it makes it easier to do business. All right, friends, so let's talk about the conversation, and here's the reality. Wall Street investors created this cute little term called the taco trade. Trump always chickens out. Here's the reality. I think personally, it's my humble opinion, I think the president uses the markets as a report card. And I think he points to the stock market as hey, the economy is doing well. Although, by the way, the economy and the stock market, while they're cousins, they're not like brothers and sisters, right? Because inflation or unemployment or, the cost of living, or just, labor wages has nothing to do with how much cash flow the S&P 500 companies are making, right? Remember, the S&P 500 are 500 of America's largest publicly traded companies. That's not a direct insight to how the economy is doing, because the U.S. economy has 150 million people, while the S&P 500, employ a good portion of that. It's certainly not the main employer. America, roughly 2/3 of employers in America are small business owners. And, that's the heart of our economy. So the message here is, I totally forgot how I started this. Oh, yeah. The message here, you could probably keep that in there in good taste. But the message here is that I truly believe that as things escalate, right, as oil continues to skyrocket, as Americans see this show up in their everyday life, and that backlash that backlash happens, I do think the president will back off. And we're kind of seeing that. We're kind of seeing signs of it in the markets, right? Because although crude oil spiked up well over $100, if you look at futures for oil and you look at deliveries of over the summer or even into the fall, that's still under $100 per barrel, at least as of this morning. So that tells me investors expect the temperatures to calm down a little bit. Then again, who the knows? So we have to plan accordingly. All you can do is control the controllable. As a prudent investor, make sure that your portfolio is aligned with your goals and there's not a mismatch there. All right, friends. So in closing, the markets do not like the unpredictability. And when investors are fearing inflation and a market slowdown, we typically like to deploy assets into real assets. And that trade has worked over the last couple of years. Whether you're investing in gold and precious metals, that's performed well. Whether you've invested into energy, that's performed well. Midstream energy, that's performed well. Real estate has bounced back. So real assets has done exactly what we expected to do during times of geopolitical tension or during times of inflationary environments or spiked interest rates. You typically want to go into real assets, and that trade has done pretty well. And there's no reason to believe that momentum is slowing down. I frankly believe we are moving towards an era of scarcity where, we're no longer, promoting globalization. Where every country is out for themselves. So that means that there's limited resources out there. And, the definition of my definition of economics is, doing the most with the least, trying to make the most of your resources. So from a economic perspective, I believe we're entering a era of scarcity. So real assets is typically where you want to be when, inflation spikes or interest rates spike or there's geopolitical tension out in the world. You want those hard assets that you can always cash out on, So with that, we hope you found this helpful. We ask that you join us across all social media platforms. You can follow me directly at Kevin Nunez NJK, at NJK Partners. Please visit our website, njkpartners.com. Feel free to schedule a consultation. Feel free to log on to our website, schedule an appointment, DM me, fax me, text me, whatever you got to do. We are here to help, and we take pride in helping out everybody. Again, with NJK Wealth, there will be no commissions, just high quality financial advice. No account minimums, and definitely no judgment. We are in this to help everybody out. And by doing good, we know that in turn, karma will do good for us. So Hope everybody has a blessed day, and we'll see you on next week's episode of Invested in Us, where we explain money how we wish it was explained to us, y'all. Peace.